Hello. In this video, I'll be going through a comprehensive problem with a finance sales type lease that has a guaranteed residual value. This video will address the lessor side, and then depending on the length, I might address the lessee side, or that may be in a different video. On January 1, 2027, Gosh Industries leased a high-performance conveyor to Carrier Company for a 4-year period ending December 31, 2030, at which time possession of the leased asset will revert back to Gosh. The equipment has a cost of $956,000 and expected useful life of 5 years. Gosh expects the residual value at December 31, 2030 will be $300,000, and negotiations led the lessee guaranteeing a $340,000 residual value. Equal payments under a finance sales type lease are $200,000 and are due on December 31 of each year, with the first payment being made on December 31, 2027, and Carrier is aware that Gosh used a 5% interest rate when calculating lease payments. When I have these types of problems, the first thing I like to do is I like to write down all the information that I already know about, just so it's easier to look at. I know that the lessor is Gosh, and the lessee is Carrier. I know that the cost of this machine is $956,000, and that it doesn't tell me when it was acquired, so I'm just assuming it was acquired on January 1. So because it doesn't say otherwise, so there's no accumulated depreciation to be concerned about. The life of this lease, the term lease, is 4 years. So I should say term, not life, because the life of the asset is 5 years, but the term is 4 years. And the interest rate that I have, the interest rate that I'm given is 5%. Okay, so that's just easier for me to see. I'm also told that the expected residual value, I'll abbreviate that as RV, is, let me see, how much is it? This is why I write it down, is $300,000, but the guaranteed residual value is $340,000, which is a $40,000 difference. So I have also right here on this right-hand side a little table about how to treat the residual value in a lease when it's guaranteed. And I have the lessor side in the middle column and the lessee side on the right. And so here I'm going to focus on the lessor, and it tells me that I'm going to include the present value of the full amount of the residual value. And that means I'm going to include that in when I calculate the lease receivable. This is what I'm talking about, the liability section, the asset and liability. The lease receivable for the lessor, I'm going to include the present value of the full residual value. The full residual value is $340,000 because that's the guaranteed amount. Now, let's just start doing our calculations. In order to calculate the lease receivable amount for the lessor, it's going to be it's going to be made up of two things. The lease receivable is going to be made of the present value of the lease payments, which equals to $200,000, we're told. Right, so that's $200,000. And I'm going to multiply that by a factor. And I'm going to use the present value of an ordinary annuity. And the reason I'm using an ordinary annuity instead of an annuity due is because it tells me that the lease started on 1/1/27, but the equal payments under the lease are $200,000 due on December 31. So it's at the end of the period. The first payment is at the end of the period. And by the way, just real quick, it already told me that this is a finance lease, so I don't need to go through the 5-step criteria to determine that, which is why we're booking a lease receivable for the lessor. Okay, so the present value of an ordinary annuity is the table that I'm going to, the factor table that I'm going to be using with, sorry, with, it's going to be, the interest is, what was the interest? This is why I like to write everything down, 5%, and n equals 4. So I equals 5% and n equals 4, the number of periods. And when I do that, that factor is going to be 3.54595. So, and that amount will end up being $709,000, $190,000. So that's the first part of the lease receivable, the present value of lease payments. This problem gives us residual value, and as a lessor, I'm going to include the full amount of the present value of the full residual value, which is $340,000. So my second part is going to be the present value of total residual value, RV, which we're told is $340,000 multiplied. This is just a lump sum, so it's present value. We're going to do present value of a dollar factor table. Again, I equals 5% and n equals 4, and that factor is 0.8227. So hopefully you know by now how to use the factor tables. If you don't, there's going to be some videos posted about how to do that from a previous chapter. But the 340 times the 0.8227 is $279,718. And the total for those two is, why is this? $988,908. Okay, so now I can start booking my receivable. That's going to be this 988,000. That's going to be the lease receivable. I want to point out here that for this specific problem, we have a sales type lease for the lessor, but we have a selling profit because the selling profit is determined by the present value of the lease payments plus the present value of the residual value, right, which is 908,908. And if those numbers are greater than the carrying value of that asset, then you have which is 956,000, the problem tells us, because that's the cost of that asset and none of it has been depreciated. So that amount is going to be, this is going to be a profit, right? The fair value is greater than the carry value, means it's you're going to make a profit. Just as if you were to sell this asset that cost $956,000 for $988,000, you would calculate a profit for that as well. So just keep that in mind. So we're going to have two entries for booking this receivable, booking this lease for the lessor. We're going to debit the lease receivable for the present value of the lease payments and the residual value for $988,908, and we're going to credit that as our sale. So we're going to do sales revenue for $988,908. That's one entry. The second entry is we have to write off this asset off of our balance sheet because because this is a sales type lease, we're going to treat it more as like a sale. So I know I'm going to credit my asset, whatever asset this is. The asset, for the cost of the asset is $956,000. And what we do here is we debit cost of goods sold for $956,000. Those are the two entries. And when you look at your income statement, your sales of $988 and cost of goods sold is $956. And so the difference between those is the profit that's going to be shown on your income statement. Okay, So this is the entry on 1/1/27, the commencement of the lease. Let's fast forward to 12/31 when we have our first lease payment for $200,000. This bullet point right here, this like almost this last one. So before we do that, I like to draw out my amortization table just because it gives me, I like to be clear of everything. I need to have everything laid out. I like to have the cash. I'm going to have interest revenue because I'm the lessor. I'm going to have my decrease in my account balance, my decrease here, and here's my my carrying value of the lease receivable is what this right here is. So in 1/1/27, my lease receivable is recorded in $988,908. On 12/31, we receive a payment. So 12/31/2027, there is a $200,000 payment that I will receive. But part of it has to be allocated to interest revenue, and the rest of it will be decreasing the lease receivable. So how do we calculate that? We're going to take our beginning carrying value, which equals 988,908, and we're going to multiply that, because this is a full year, by our interest rate that we are given, which we are told is 5%. So, and that amount is going to be $49,445. And that's going to go right in here. That's going to be our interest revenue, $49,445. And then the difference between the $200,000 payment and interest revenue, the remaining part of that is going to be the reduction to my lease receivable. And that is $150,555. Okay, now I can book my entry. So let's book the entry. My entry is I received cash for $200,000. I am going to reduce my lease receivable. So I'm going to credit my lease receivable off of my balance sheet for $150,555. And I'm going to recognize this interest revenue component of it for $49,445. I'm going to stop the video there, and there's going to be a separate video for the lessee portion of this problem.